Hi, I'm Jim Jubek, and this is my YouTube video for Jubek Asset Management for Thursday, January 25th. As you notice, I recently got my Junior Gondoliers membership. Unfortunately, it comes with a Junior Gondoliers hat, which I've been informed I don't get the full-size hat until I pass my gondoliers test, which involves rowing a boatload of obstreperous passengers down the canals of Venice and not losing any of them. So until that happens, which could be quite a while, I'm going to go back to my Toledo's Mud Hens hat. Okay, yay, go Mud Hens. Baseball season's around the corner. Okay, if you like this video and want to see more, you can sign up for my free YouTube videos. Basically, get a notification when a new one goes up. We're doing about 3 a week. If you want more of my stuff, you can go to my free site. That's jubekpicks.com, and that has 3 portfolios. And as I said, it's free. And then there's my paid site, which is jubekassetmanagement.com, jam, and that has 6 portfolios. And whereas I usually post maybe 1 or 2 posts a day on Jubek Picks, I tend to do 2 to 4 posts on Jubek Asset Management. So that's what you get for your extra money. You can find links to all those down below. Okay, today's topic is too fast, too far, or too far, too fast, whichever you want to do. And it's comes to mind because yesterday on the January 24th close, we basically had hit the end of 2024 targets 3.5 weeks into 2024. So the consensus target, I need to read all this, consensus target for the end of the year close is an average of 48.67. Yesterday, the S&P closed at 48.68. So basically, hey, all of 2024 is already done. We do have a little more if we go to the median as opposed to the average. The median forecast for the end of the year is 29.50. So maybe another 80 points from here. And then if we go to the high end of the scale, you can find forecast for 5,200. So that's 350 points from here. The point is that we've already blown through a lot of these targets. Have we gone too far, too fast? Are we looking at some kind of a reset that takes us back down? Are we looking at revisions to these analyst estimates, which we got in 2023 when analysts all proved to be pretty much too low? Here's my read on this. I think that we're still looking for confirmation that the Fed is going to start cutting rates. Probably not going to happen in March, and we might see some disappointment in March. It probably is going to happen in June and July, at which point we get confirmation, which people who were skeptical and sitting on the sidelines say, hey, this is really going to happen. I think at that point you get some more money into the market. And I then think the question comes to be, so if you have more money, if you have confirmation in the middle of the year, and you're clearly sitting over the projections for the end of the year, it's hard to figure out the reward for the risk you're taking. Stocks can go down as well as going up, even though right now it seems they only go up forever. But we all know that's not true. If we think back to 1999 and 2000, when technology stocks busted through this, I remember the portfolio return for that year from my portfolio was 95%. Gave back most of that in the following year and a half in a really nasty bear market. But nonetheless, this starts to feel a little bit like that. And the key question here is, okay, so at this point, people are chasing momentum. It's very clear. They're not chasing fundamentals, they're chasing momentum, and you've got a lot of fear of being left out, especially after 2023 when most major money managers were wrong about how the year was going to go. So they don't really want to pull things out before they get their last bit of gain for 2024 to make up for 2023. So I think all that tends to support the market. All that also tends to argue that the market is very, very risky at this point, and that there's not a whole lot of reward here. You're not looking at a market that's 400, 500 points below where it's going to be at the end of the year, you're looking at a market that maybe moves sideways by the end of the year, that we've seen our best, and that what we're going to see in between is up and down and up and down, and maybe we'll finish the year flat. So the key point from this takeaway is not a lot of reward for the risk, not a lot of big moves on the upside. So basically make sure that you are paying some attention as much as you can to fundamentals, trying to not go really risky out there, and basically keep your eye on the risk as well as the reward in this market. So thanks very much. It's been Jim Joubek. If you like this video, please sign up for my free YouTube videos. Link to that down below, and it gets your notification of when each one shows up each week. You can also subscribe to my free site, that's joubekpicks.com. That's got 3 portfolios for long 12 to 18 months, 5 years, and then dividends. Or you can subscribe to my Joubek AM paid site, and that has 6 portfolios. So we do some options, we do some much shorter, more volatile plays, we do some volatility, and you can find links to that down below. Thanks very much for watching.